Under the broad-based semiconductor industry, I'll be discussing some of the driving factors, including the size of the industry and the performance of the industry. So for the next segment, I'll be talking about the business models in the semiconductor industry. I'll be reviewing some of the major players in the subsectors like the integrated device manufacturers, Fabless, Foundry, and semiconductor equipment suppliers. And lastly, I'll be discussing some of the trends in the industry. Semiconductors lay the foundation for the advancement of modern-day electronics, and with the increasing demands of consumer electronics, this drives the demands for semiconductors. If we look at the global share, global sales market share, the US has actually managed to maintain its dominance at approximately 50%. And in contrast, if we look at Japan, which 20, 30 years back then, they used to have about 50% market share. Now they're actually only at about 10%. And they have lost market share to its competitors in Korea, Taiwan, and even China. So some of the drivers in the industry would be the Industry 4.0 and smart factories. So what we've seen is that with the increasing need for optimization of supply chain and manufacturing factories, what we can see is that even Amazon have robots like moving goods around their warehouses. This allows for cost reduction and better use of floor spaces. Another key point would be through the adoption of automation as well, autonomous systems. This would fall under largely what we see as electric vehicles, whereby they have advanced driving systems to support autonomous driving. So the next factor would be big data and machine learning. So this whole portion on AI involves the entire industry, including storage, memory, logic, and network chips. So a couple years back, right, I believe IBM has this very famous quote whereby they said that 90% of the world's data has been generated in the past couple of years. And it's not about the amount of data that's important, but what organizations do with that data. And that's why I think in this sort of like space, we see that there are a lot of advertising algorithms that are targeted, that are deployed by Facebook and Google, that are targeted to the end consumers. So the next point would be also cloud computing and data warehousing. This goes in conjunction with big data and machine learning as well. And for 5G, we believe that 5G will also accelerate the replacement cycle for smart devices. Remote workplace is the new normal. So I think this sentence is can be quite backed up by Dell's recent earnings, whereby they've seen consumer revenue surge 18% year on year, and with strengths in government and education sectors all up approximately 20%. So the industry, despite being cyclical and being battered by the US-China trade restriction back in 2018, have actually managed to remain resilient across a 10-year period. So semiconductors are also largely influencing the advancements in the automotive industry, with EV penetration poised to be above 50% in the next 5 years. And it is also likely that the automotive sector will be contributing to the growth in the industry, as there will be greater demand for such devices. We also noted that wireless communication is the key area of growth. As 5G rollouts gain traction globally, we believe that its use cases will expand beyond smartphones to industrial IoT. So according to the World Semicon Trade Statistics, the semiconductor market is expected to increase 3.3% in 2020. This number was previously revised downwards from 5.9% and approximately 6% in 2021. And in contrast to that, we have the S&P earnings decline of approximately 20% in 2020. So this sort of gives some justification as to why the semiconductors are actually outperforming the S&P 500. So the industry still remains robust and poised for growth as supported by the industry's capital expenditure. So over here, we have 4 main sort of subsectors. And what we can see is that there's according to this chart, Bloomberg classifies Intel's and Samsung's capex under logic and memory respectively, and therefore it appears that foundry is slightly underweighted. But if you were to readjust the such spending, Foundry would actually make up the largest proportion of spending, approximately 37% of all capital expenditure. And I'll discuss more about all these players in the next couple of slides. So this is the chart of the 10-year revenue growth for the Semiconductor Index and the S&P 500. So in the previous slide, like I've mentioned, that the capex for the industry is actually growing rapidly, and what you can see here, the Philadelphia Stock Exchange Semiconductor Index, also known as SOX, right? It's a market cap comprised of companies primarily involved in design, distribution, manufacturing, and sales of semiconductor, versus the S&P. What we can see is that the 10-year compounded annual growth rate for the SOX is actually at 8.6%, in contrast to the 3.7% revenue growth in the S&P 500, which shows that this is actually more of a high growth market. And then again, we can see that revenue growth is slightly muted from 2011 to 2015, which sort of shows that this is a cyclical industry as well. So I think one thing to take note also in the whole semiconductor space would be that there's a sort of a gravitational pull towards a handful of companies driving the industry. And the same can be said for the broader tech companies, where we get a sort of a winner-take-all situations. And especially when capital expenditure is extremely intensive, we do note that the strong are getting stronger and the weak are getting weaker. So if we look at the historical PE ratio for the SOX versus the S&P index, the growth of the industry should actually bolster the support for cases surrounding the PE expansion. And as we are entering Q4 of 2020, one thing to take note is that that PEs are near historical highs for the past 10 years, and that the forward earnings are supposed to bring down the PE ratio to approximately 27 to 28 times. So we have a couple of business models in the semiconductor industry, of which I think the most notable ones, I've listed them here. So the first, we have the integrated device manufacturer. So these are the companies that design and manufacture its own branded chip in-house, while traditional IDMs enjoy higher margins. As integrated circuits complexity gets higher, the ability to sustain those margins get eroded by process inefficiencies. So this is one thing that we noted in Intel, whereby the operating margins are actually going down. And as they move on to the next generation, so they just recently moved from 14 nano process to a 10 nano process, we've seen their operating margin come down quite largely. So the next, some other companies in there, so you have like Samsung Electronics and NXP Semicon. So the next business model will be for Fabless. So fabless companies are companies that just design and sell semiconductor chips, and they have outsourced their entire fabrication and manufacturing process to a foundry. So this would benefit, these companies would benefit from lower capital expenditure and they typically focus their R&D on chip advancements, chip architecture, and on sales and marketing. So some companies, we have the NVIDIA, Qualcomm, AMD, MediaTek, and HiSilicon. So these, so just at the top of my head, I think NVIDIA is currently manufacturing most of its processors with Taiwan Semicon, especially their A100 GPU. And then for their recent 30 series launch, they're actually manufacturing on Samsung's 8 nano. So Qualcomm is have recently moved to Samsung for their new flagship Snapdragon 865. However, previously they have always been with Taiwan Semicon. I think AMD is also running on Taiwan Semicon's 5 nano process. And I think HiSilicon is owned by Huawei, is a whole subsidiary. It's a fabless company that's wholly owned by Huawei, and they and I'll share a little more about how the chips and how these chips and how they play in the entire foundry and fabless ecosystem. So for foundry companies, they purely operate on semiconductor fabrication plants, and they focus on manufacturing integrated circuits for other companies without designing them. So I think one of the more common names they see out there will be TSMC and SMIC. So TSMC is known to have have the lion market share of this whole pure play foundry sector. And the last point would be the semiconductor equipment suppliers. So over here, we have the companies that manufacture equipments used in fabrication plants and semiconductor facilities to design and develop semiconductor chips and components. Some of these companies would be Applied Materials, Lam Research, and ASML. So these are the lesser known sort of like sub industries, and they consist of the smaller players out there. So we have the electronic design automation companies, which provide a suite of softwares for designing electronic systems, and we have Cadence Design Systems at Synopsys. Under automatic test equipment suppliers, we have companies that manufacture testing equipments and kits to rapidly identify flaws in semiconductors. So we have leaders like Teradyne, Advantest, and even our very own AEM that's listed in SGX that falls under AT suppliers. And last but not least, we have the outsourced semicon assembly and test vendors. So these companies provide third-party integrated circuit packaging and test services. So some of the bigger names in there would be ASE Tech, MCore Tech, and JCT, formerly known, and they've previously acquired StatChipAct, which was listed in the Singapore Stock Exchange as well. So this is the brief overview of the industry's ecosystem. So all the way at the far end of on the left-hand side, we have the equipment suppliers, to which they will be supplying to the IDMs and the foundries. So the next sort of like key subsector that comes into place would be the electronic design automation companies. So these companies will provide the software tools for both IDMs and fabless companies to come up and design with their own chips. So the fabless companies will then either go to IDMs or foundries. So I think it can get quite confusing here because so let's say for instance Samsung is an IDM, but it also provides external foundry services. So let's say for instance like Samsung for its Samsung manufactures on behalf of Qualcomm's Snapdragon series. At the same time, they also manufacture and directly compete against Snapdragon with their Exynos chip. So these chips are actually predominantly used in the Samsung Galaxy line that you can see. And therefore, fabless companies can actually contract IDMs or foundries to do the manufacturing for them. But in the typical scenario, we would see that fabless companies like NVIDIA, AMD, and such, they would head to Taiwan Semicon or Samsung Foundries to actually do their production. So the next stage would be that the IDMs and foundries would contract OSATs, and OSATs are the outsourced semiconductor assembly and test vendors, where they'll do the system testing, packaging, and sort of like the logistic aspects of it before having the finished semiconductor product. And for the outsourced semiconductor assembly and test vendors, more often than not, they receive their testing equipments from AT companies. AT companies are the automatic test equipment companies suppliers, and then they're the ones that provide the testing equipments to identify flaws in semiconductors. So this is a brief overview of the ecosystem and how they work hand in hand. So the first company that I'll be going through, they'll be diving deep, it would be Intel Corp. They're one of the largest IDM manufacturers out there. They are the most predominant producers of chips for servers, desktops, and notebooks currently. And they have 6 wafer fabrication sites with 4 assembly test manufacturing locations worldwide. So what they've done is actually they've brought everything in-house. So they brought chip designing, chip manufacturing, and chip testing in one company. So what you can say is like they brought Fabless, Foundry, and OSAT together. So they are able to actually capitalize on their global network to reach out to their customers. Some of the company metrics would be it's trading at almost a 9x PE ratio with a market cap of approximately 200 billion. So one interesting thing to note also is that based on its revenue breakdown, approximately half of its revenue comes from client computing, whereas about a third comes from data center group. And about 7% from non-volatile memory solutions, which they've sold this unit to SK. Some business outlook for the company would be that in its most recent quarter, announced a couple of days ago, data center revenue is down. It's been impacted by COVID-related factors, and enterprise and government market sector is down 47%. So Intel is also selling its NAND business to SK for approximately $9 billion. So this divestiture is seen as a positive news to the market as this deal potentially increases operating margin and reduces capex. So although the mobile eye contributes to a small proportion of its total revenue, the automotive industry recovery would also be beneficial. And I think one thing to also note would be that many of the PC enthusiasts or the consumers, the end consumers, are actually looking forward to this Intel Iris Xe Max discrete graphic. So this directly competes with NVIDIA and AMD. So NVIDIA's RTX series and the AMD Radeon series. And what we do note is that because Intel's laptop market share is hovering at approximately 80%, it will be easier for Intel to cross-sell or rather include their discrete graphic cards into their end consumer products. So rather than now laptop manufacturers, if you were to take a look at one of the more higher spec laptops, what you'll see is that it usually comes with Intel graphics card with Intel's CPU, and NVIDIA's graphic card. So some potential upsides might be limited for Intel, as we can see that the share price has been bashed down recently. Would be that I think since the last quarter, the management has confirmed that their 7 nano has been delayed again due to yield degradation issues. So this yield degradation issues is not uncommon in foundries. However, one cause for concern would be that most of their competitors are actually on 7 nano and 5 nano processors. So competitors like AMD is also taking CPU market share from Intel, which is quite worrying, considering that Intel has predominantly owned most of the market share the past couple of years. And potential threat by further adoption of ARM CPUs. So this is one point that caused waves in the markets, whereby Apple has decided to drop Intel for their line of MacBooks, and they are said to actually be designing their own chips and getting TSMC to manufacture it for them. So this is the brief market share of Intel and AMD's x86 CPU worldwide. And as we can see, I think the market is trending towards AMD as AMD has AMD CPU offer a better price to performance ratio as of its latest Zen 3 release, and therefore we see that this trend might continue to persist as long as Intel does not resolve its 7 nano manufacturing process. So I think from the latest earnings briefing, also Bob Swan, the CEO of Intel, has also mentioned that they have actually yet to come up with a solution. They're still deciding on whether or not to seek to sort of outsource certain processes to TSMC. So I think their share price would more or less stabilize when we get such confirmation. So Intel still currently holds approximately 80% of the laptop CPU's market share, and we also can see that AMD is gaining traction there. So we believe that for Intel to remain slightly competitive, they have to at least offer better price to performance ratio for their CPUs, which I think can be seen from their 11th gen Tiger Lake chips. At the same time, also I think we've yet to see the demand for their discrete graphic cards. So those are some catalysts to take note for Intel. So that we can see the exact point where the share price for both Intel and AMD diverged. So here I have a 1-year price performance for Intel and AMD. Their share price has generally moved in the same direction since the start of the year. But the share price performance for the companies only began to diverge when Intel started losing market share to AMD. So I think one company that most of us are pretty familiar with because it's listed on the Singapore Stock Exchange would be AEM. So AEM is a solution provider for back-end testing of the semicon manufacturing process, and it falls under the AT subsector. And one notable point to take note would be that it derives more than 90% of its revenue from Intel. So kind of a concentration risk there. And it benefits from the so AEM overall benefits from the increasing demand of SLTs or system level testing, and semiconductor chips are getting more and more complex as the node processes advance. So some factors that will be bolstering its earnings is similar to what we see. So the drivers in the semicon industry, strong semicon equipment billings, and perhaps some diversification of customer and revenue streams. So the next business model that I'll be covering would be the fabless companies. One key example would be NVIDIA. So NVIDIA designs and develops computer graphic processors and mobile chipsets. So its GPU primarily focuses on the gaming and professional markets like video editing, image processors, and machine learning and AI and such. So we're looking at a PE ratio of approximately 85 times and market cap of about 324%. So I think one main difference that we can see in contrast to IDM like Intel, for instance, would be that the capital expenditure to sales for NVIDIA is approximately 4%, whereas it's significantly higher for Intel at 22.5%. And this is due to the capital intensive nature of foundries and manufacturing plants. So you can think of fabless companies as asset-light companies or rather design companies. So this is the revenue breakdown for NVIDIA's latest quarter. So approximately half from gaming, half from data centers. And one key trend that we have noted is that their data center revenue has been creeping up. And in the past, you can easily see that NVIDIA heavily relies on its gaming sector, with gaming contributing to approximately 70% of its total revenue, and now it's at about 40%. So some business outlook for NVIDIA. Q2's total revenue is up 50% year on year, with data center revenue up 167% year on year. So NVIDIA is clearly capitalizing on the data center trend, and its Mellanox acquisition made in April 2020 has had its growth accelerated. So this Mellanox has contributed to approximately $500 million in revenue, in contrast to the $400 million in the quarter prior to acquisition. And Mellanox plays a role in its next architecture, the Ampere architecture. So the NVIDIA A100 chip is based on TSMC's 7 nano process. It forms part of the NVIDIA's entire high performance computing HPC and data center solution. So what it offers is that it's up to 6 times 6 times performance for AI training, 7 times performance for multi instances, 2 times for high performance computing and simulations from the previous gen of V100 chips. So this A100 chip is actually widely adopted by all major server vendors out there. including Alibaba Cloud, AWS, Baidu, Google Cloud, Microsoft Azure, Oracle, and Tencent Cloud. So one of the other things to take note is that recently they had the launch of their RTX 30 series in September. So this is their discrete graphic processing unit powered by the Ampere architecture. And this is an essential replacement cycle for gamers and content creators out there. And it's based off the Samsung 8 nano process. So one thing that you can take note is that NVIDIA is actually partnering up with foundries like TSMC and Samsung to handle all of its manufacturing needs. And that's why it can be asset light, and therefore its capex to sales is actually significantly lower in contrast to its to IDMs. So some other key things that would make NVIDIA an interesting company going forward would be its partnership with with Mercedes. So the next thing would be that its proposed ARM acquisition. So NVIDIA is to acquire ARM for approximately 40 billion and is expected to be accretive to gross margins and EPS. So what is ARM? ARM is a British semiconductor and software design company owned by SoftBank. It primarily licenses its processor designs and technology as IP to companies who want to use them. So let's say, for instance, Apple is one of these companies that licenses ARM's architecture and designs. So the ARM architecture, why is it so popular? It's because that it requires fewer transistors in contrast to the traditional x86 architecture that you've seen in Intel CPUs, AMD CPUs, and such. So this improves cost and reduces power consumption, which is very important for mobile processors like laptops and mobile phones. So NVIDIA's Tegra processors also is based on ARM's architecture, and NVIDIA Tegra is a line of mobile processors which powers consoles and such. So I think one sort of like famous console that we can find the Tegra would be in the Nintendo Switch. And I think that the Nintendo Switch, ever since COVID started, COVID pandemic happened, we've seen that the gaming console has actually sold approximately 66 million units worldwide, extremely popular. So one of the business outlook for NVIDIA would be that because ARM is mainly ARM has global end clients users out there. So we have Apple, for instance. We have HiSilicon, which is owned by Huawei previously, for instance, all running on the ARM architecture. They have a diversified client base. So there's been speculation or talk in the market whereby people are talking about how China will actually block the acquisition to prevent US tech dominance. So this is one key thing to take note also, that should there be any regulatory bodies that disapprove of this acquisition, this might lead to some downward pressure on the stock. So another popular company in the fabless space would be Qualcomm. So Qualcomm engages in the development and design of digital telecommunication products. So they have two main industries, the QCT and QTL. One is technologies, and the other would be licensing. So you can think of the QL, the licensing sector as something like as a mini ARM, whereby they lease their architecture and their intellectual property out to other companies. So they have a P ratio of approximately 42 times with a market cap of 142 billion. So like NVIDIA, their capex to sales is actually 3.7 times, which is extremely low. And this is because they've actually subcontracted out all the manufacturing to the foundries. So some business outlook for Qualcomm would be that the modem chipsets shipments is expected to increase significantly, 20% quarter on quarter. This shows that there's a huge rebound in consumer electronics. Qualcomm also expects 1 billion in 5G connections by 2023, with 5G to account for slightly under half of all traffic by 2025. So like all the other companies that are in the semicon space, most of them will actually benefit from this 5G play. So some key updates for the business would be that Qualcomm also has reached an agreement with Huawei on its licensing. So they had previously had some patent dispute, and Huawei will be making an additional 1.8 billion payment to Qualcomm for unpaid licensing fee. So the US restriction on Huawei could also pose as an opportunity for Qualcomm. So Qualcomm has actually submitted to the US government a sort of a request for approval for it to actually provide chips to Huawei's new line of smartphones. So as we've noted also is that because that HiSilicon, which is owned by Huawei, the Fabless company HiSilicon is unable to actually procure chips from Taiwan Semicon. So as Taiwan Semicon heavily relies on US technology, so they are actually unable to manufacture on behalf of HiSilicon. So therefore, this restriction, right, might lead to additional business that has been transferred to Qualcomm should the US government approve Qualcomm of supplying chips to Huawei. So the new Qualcomm Snapdragon 875 chipset is also to be manufactured by Samsung Foundry. So this will give an uplift in terms of its and bolster its earnings due to Samsung offering the chip manufacturing process at a lower cost. However, I think it is also mentioned by the CEO that they might be moving back to TSMC should there be further advancements in their 5N process. So this is a key. This is a snapshot of the popular phones out there and the brands and such. So under Apple, we have the A series chip, most recently the A14. So chip architecture is based off ARM, and the chip manufacturer is TSMC. So for Samsung, Samsung has two lines of chips in their phone. Based on different regions, you might see a different chip in there. So for most of developed markets, you'll see the Qualcomm Snapdragon, and it will be currently manufactured. It will be manufactured by Samsung Foundries going forward. And for Huawei is it's a mystery at the moment, but in the past it is used to be based on the ARM architecture and manufactured by TSMC. So the next company would be Taiwan Semicon. So it's the largest foundry company out there, and it is the pioneer to pure play foundry business. It's a pure play to the foundry business model. So what we can see is that just a quick glance at the company's metrics, we will notice that the capex to sales is extremely high. So in contrast, just a quick refresher, right? The fabless companies have approximately 4% capex to sales in contrast to foundry. However, Taiwan Semicon has a very high operating margin, and this is because of their technological advances as well. So its operating margins can be seen as slightly cyclical, whereby whenever they move on to a new process node, you can see operating margins actually fall, and it will normalize only after 2 years and such. So it's extremely large, 400 billion in market cap, and you can see the revenue breakdown in terms of sector, where the main focus in HPCs are high power computing. So this is where you see your data centers, supercomputers and such, and smartphones also contributing approximately half of its revenue. So some of the so a brief business outlook guidance would be that its recent revenue from smartphone is up 12%, HPC is up 25%, IoT is up 24%, while revenue from automotive is actually down. Data communications also down. But these two sectors only make up these automotive and data communication sector only makes up approximately 5% of TSMC's revenue. Therefore, and we also anticipate that there will be rebounds in these two sectors going forward. So another thing is that its Q4 revenue guidance by management is approximately 12.6 billion. So it'll be up 20% year on year. And the sequential growth is to be supported by strong demand for its 5 nano process, which it's managed. TSMC has actually managed to sort of like perfect the yield for 5 nanos. So TSMC will remain committed to heavily invest in capex to increase its capacity, as they have also mentioned that they're actually running at full capacity for quite some time now. So some of the positives and negatives for the company. Let's start with the positive side. Gross margins and operating margins have remained strong and is expected to be supported by their process technology leadership. So TSMC has already sort of perfected its 5 nano process. In contrast, Samsung has just reached there. And then if we look at Intel, right? Intel is still on its 7 nano process and it's still working on its 7 nano process. So most of the chips that Intel actually are selling right now is it's 14 nano and 10 nano processors. So Intel is a couple years behind TSMC's process tech, and therefore it gives us reason to believe that companies that are companies that are running on TSMC's process technology would have a better chip efficiency, better energy consumption, and higher chip density in contrast to Intel's chips. So there will be a mini boom for TSMC as well, as Huawei has stocked up on chips before its latest sanction took effect. TSMC has also captured 85% of the market share with its 7 nano process, and this trend will likely continue according to management as well, as it is also the first to sort of like commercialize the 5 nano process. So some key specs would be that the 5 nano process offers 15% faster speed, 30% less power, and 18% higher chip density, which will drive the demand from fabless customers. And as we speak, I think TSMC is also still working on its 4 nano and 3 nano processors. So that's one key thing to look out for as well. So positive thing also would be that Apple is to switch away from its Intel processors and to build its Mac CPUs with in-house chips that will be manufactured by TSMC. And Intel is also exploring foundry options with TSMC, and Qualcomm is also said to return to TSMC on its 4 nano process. So these are some things that will be contributing to Intel's revenue growth. So on the negative side of things, we have Huawei, which is their second largest customer, contributing to 14% of FY 2019 revenue. So they are unable to procure chips, and therefore what we can see is that TSMC, being the sort of like the go-to foundry manufacturer for chips, should Qualcomm get the US government's approval for the chips, and if they were to supply it to Huawei indirectly, I think the business stays within TSMC. So at the same time, also the rapid 5 nano process adoption, right, by customers will lead to margin dilutions. So for margins to actually return to normalcy, we typically give approximately 2 years. And we've seen the same margin dilutions with Intel as they move to 10 nano. So some negative things will also be that the PE expansion has to be justified by solid quarters and management guidance going forward. So should there be any shocks to the markets in terms of its guidances, we might see a steep decline in its share price. And it might be susceptible to geopolitical risks as 22% of the revenue of its revenue is derived from China. So the next company that I'll be covering would be Applied Materials. So they are a semiconductor equipment supplier. So what they do is primarily manufacture equipments, services, and softwares to the semiconductor, display, and related industries. So if we look at their key metrics, price earning is approximately 16 times, which is normal in the semiconductor equipment supplier sphere. Market cap is approximately 50 billion. Revenue growth is healthy at approximately 12% 3-year average. Operating margin is at 22%, and capex to sales is 3%. So what we've noted is that this number is slightly on the lower end, which might show that they're not spending a lot on R&D. And I'll discuss more about their competitors' products in the next couple of slides. So revenue breakdown for them would be that 67% is derived from semiconductor systems, and 23% is derived from global services, and 10% is derived from manufacturing displays. So for companies like Applied Materials, ASML, and Lam Research, a large portion of their earnings correlate to the demand of front-end foundry equipments. So if we take a look at the quick snapshot of their third quarter 2020 total revenue, it is up 23% year on year, with systems revenue for up 28%, and operating margins extremely healthy. It's up 600 basis points. So revenue guidance for the fourth quarter would be approximately 4.6 billion. It's up 22% year on year. And then this is some of the key drivers that management has sort of like directed us at would be that for fabrication equipment, it's likely to actually help with sales growth, and the trend is likely to persist as foundry customers migrate to more advanced processes. So they've also managed to resolve their supply chain issues, which was previously present during the whole present in Q2, and this led to a huge backlog which they've managed to clear, and they're now currently operating at pre-COVID levels. So AMAT has also noted that its Huawei restrictions are likely to be immaterial, as they believe that the impacted share will be shifted to other competitors. So this is like the analogy that I've given previously with Taiwan Semicon, whereby even if Taiwan Semicon were to lose high silicon's business, it might come back indirectly through Qualcomm. So some of the key risks for this company would be that it is actually losing lithography market share. So ASML, which is one of its competitors, is the only manufacturer for EUV machines. So EUVs are the extreme ultraviolet lithography machines. So essentially what it does is it uses a process of light to print blueprint patterns on silicon. So this is a fundamental step in mass producing chips. And so EUV reduces the need for DUV lithography equipments, which are both predominantly supplied by AMAT, Lam, and ASML. So ASML with this EUV machine is actually ahead of the game in the whole semiconductor equipment supplier, and we will see this trend persist, whereby ASML is actually going to be taking market share should there be a quicker transition to smaller node processors. So I think another thing to highlight would be that EUV machinery is extremely expensive. I did a brief look up on the prices, and it's about $135 million per machine, and it has a lower production output, about 120 to 170 wafers per hour, in contrast to the older equipment, deep ultra DUV equipments can produce approximately 275 wafers. So however, but with that being said, also one layer of EUV replaces 3 to 4 layers of DUV. So should any foundry company be willing to spend the amount of capital expenditure on acquiring EUV machines, they are actually able to optimize production efficiencies. And what we've also heard is that TSMC actually owns more than 50% of all installed EUVs at the moment. And that, therefore, they are actually able to ramp up their 5 nano process manufacturing. So I think another local player here that we have, UMS Holdings. So they are largely tied with AMAT earnings as well. So what UMS does is primarily manufacture front-end semicon equipment, so the fabrication equipment and such, and components in assembly and testing devices. So it supports AMAT, and it derives more than 90% of its revenue from them. So like AEM and such, right? It benefits from the overall driver in the semiconductor industry and strong semiconductor equipment billings. At the same time, right, with the increasing demand of capital expenditures, increasing demand of front-end equipments and foundry capital expenditure, this will likely bolster UMS's and AMAT's earnings. But then again, I think one key thing to note is that ASML is currently taking lead in terms of market share in this industry. So this is the revenue growth, the 10-year revenue trends for some of the companies in there. So we have Applied Materials in the top line in green, and we have ASML in orange. So one thing that we have noticed is that although all the players, we've seen revenue growth across most semiconductor equipment suppliers, and there's been an uptrend since 2016. One thing that we can see is that ASML's revenue growth is actually overtaking AMAT's revenue growth, and this can be worrying for AMAT. At the same time, I have to highlight also that ASML is actually trading at almost 2 times of Applied Materials valuations. They are trading at approximately 30 to 40 times PE. So likely some of the growth, some of his potential growth and his stake in the market share has been priced in. However, I mean this uptrend in revenue is in line with what we've seen with foundry capacity expansion. So what we can conclude also is that revenue from equipment suppliers directly correlates to foundry capital expenditure, which we expect to be on the uptrend driven by TSMC and Samsung Foundry. So just to give everyone a brief overall view of the current market share at the moment, there's Applied Material and ASML has 20% of the market share each, and Lam Research has approximately 14%, Tokyo Electron as well, and followed by the smaller players. So according to Semiconductor Equipment and Materials International, SEMI for short, mid-year forecast, the global sales of semiconductor equipment manufacturing is projected to increase about approximately 6% in 2020. So SEMI has also added that the increase in sales will rise another 15 to 20% in 2021. So we're looking at approximately 20% growth in 2021 for this industry. So the growth will primarily be driven by memory spending again after we've seen it deep in 2018, 2019. Memory spending will be increased due to the increasing need of data centers and the investments in leading edge technologies. So as companies progress further into more advanced node processors, we'll see more semiconductor front-end equipment sales. So some trends in the industry would be that there's a rise of fabless models. So in 2001, right, there are actually 6 times the number of semiconductor firms manufacturing leading edge chips, and currently now we only have 5 of them remaining. So these foundries foundry companies or IDM companies, right, have pretty much consolidated or have lost their business across the 20-year time frame. And this is due to the high barrier of entry, the huge capital investments required for foundry. And remaining chip companies are actually from Taiwan, South Korea, and US. So due to the intense competition in this industry, many fabless players would lean towards partnering with a foundry like TSMC, Samsung foundry, than to invest in manufacturing capability. So this is where we are looking at most companies actually heading towards fabless models. So there's also a gradual erosion of US shares of manufacturing, and this so in 2019, right, all 6 new fabs that are open globally were outside of the US, with 4 being built in China. And this progress, right, China moving towards its chip independence sort of like strategy, has been hindered by the restrictions that the US have made. However, going forward, we think that with a Biden presidency, right, the US's stance on China might be lax, and therefore China might be still on track towards its goal of bringing foundries and chip manufacturing back. So favorable economic conditions and cheap labor costs in APEC are also some driving factors as to why we can see an erosion of the US market share in terms of in contrast to the Asian peers. So some other trends that we see in the industry would be that NVIDIA, we have a whole list of mergers and acquisitions that were done in 2019 and 2020. So some of the more notable ones in the news today would be NVIDIA to buy ARM Holdings for 40 billion, AMD to purchase Xilinx. I'm not too sure if I got the name right, but yeah, for 35 billion as well. So many of these companies are actually, many of the more recent acquisitions that we see, we notice that companies are capitalizing on their high share prices that they have today to make purchases. So a lot of these purchases, right, are actually made through share, mostly funded by share swap agreements. So AMD is doing the entire 35 billion in terms of share swaps, and for NVIDIA is approximately 30% cash, 70% shares. So along the way, also we have quite lots of sizable deals like Analog Devices to acquire Maxim Integrated Products, 21 billion. Infineon acquires Cypress at approximately 9 billion, and NVIDIA acquires Mellanox Technologies for 7 billion. So what we see here is there actually a trend towards industry consolidation, whereby they've seen competition rise drastically, and as the barrier of entry for fabless companies remain lower in contrast to all the other subsectors of the industry, one thing we can note is that strong competition is likely to persist. So there will also be a rise of semicon automated testing equipment's demand. So this is one thing to take note, as there's an increasing complexity of chips, and this will increase the demand and scope of automated testing. So automated testing can also extend beyond identification of defects. It allows for manufacturers to assess test results and to modify components for higher yield or power efficiency. So these are some things that we do take note, would be that there are some trends in the industry that investors can capitalize on. But with that being said, also I think that the tech industry is trading on the more pricier end of things in contrast to global markets, and therefore we expect that the 5G growth and replacement cycle, in addition to the whole industry 4.0, to be uplifting the earnings for the entire semicon industry.